Stock splits have been the talk of the market over the last year or two, and for a lot of good reasons. There's been a number of huge stock splits from stocks that have gone up to over $1,000 per share. That's gained a lot of attention. It brings more liquidity to the market. I've done a number of videos on the reason that companies do stock splits, even though it doesn't change the fundamental ownership of what you own in a company. But it does seem to help the stock price, at least over the last few months. But a more fundamental driver of a business and the returns that you're going to generate as an investor is buybacks. Buybacks are when a company buys back shares of its stock on the open market, so there are fewer shares outstanding. If there are 100 shares outstanding in a company that's worth $100 billion, they buy back 10 of those shares. Now there's only 90 shares outstanding. The value of the company should go up by about 10% per share. Now, that's an approximation, but that's generally how it works. And if you buy back stock at an attractive price, like I'm going to talk about with some of these stocks today, this can be a tremendous way to add value to investors, because once multiple expansion starts happening, a stock goes from a PE multiple of 4, 5, 6 sometimes to a PE multiple of 15 or 20, this will add fuel to that. So I'm going to go through 4 stocks today that I think are major beneficiaries of buybacks. They're buying back at the right price, and they have the right kind of business to do these buybacks. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsored The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's get to the first stock, and that is MGM Resorts. Now, I have covered MGM Resorts and their cash flow and buybacks here, but I want to just put these in one place. I'm going to start with MGM's free cash flow. This is their free cash flow from the business. You see that they were starting to improve before the pandemic. Obviously, the pandemic was not good for MGM Resorts, but coming out of the pandemic, just tremendous cash flow coming from the business. They've also sold a lot of their real estate. That's helped them reduce the amount of debt. And what exactly are they doing with the cash that they're now generating from the business? Cash that can't be invested to expand the business, because there's not a lot of places you can expand in Las Vegas or Macau. The only major casino that they have on the docket over the next decade is in Japan. So instead, what they're doing is they're buying back stock. You can see from this chart that they have been buying back billions of dollars worth of stock each year over the last 3 years. And that has reduced their shares outstanding from 579 million shares outstanding to now down to 345 million shares outstanding. This doesn't even include all of the recent buybacks, because this is an average number throughout the quarter. So the actual number is actually lower than that. But this is a company that's trading at a pretty reasonable value. Price to earnings multiple is about 15 times. Now, that actually includes a lot of non-cash costs like depreciation and amortization that you have to pull out with casino companies. The price to free cash flow as a result is much better at about 8 times. Management says that if you pull out some of their other assets like BetMGM, like their resorts in Macau, which are actually publicly traded, you pull out all those values, the core business only trades for about 4 or 5 times EBITDA, which is a proxy for cash flow from the business. So they're just going to keep buying back stock as quickly as they can with their cash. This is something that I think we're going to see for the foreseeable future, because, like I said, MGM does not have the ability to invest billions of dollars in new casinos anymore. This is just a cash flow machine. So I think this is going to continue. One of the reasons that this is one of my favorite stocks right now. The second one was one that really surprised me when I started looking for more companies that are doing huge buybacks. That is Avis Budget Group. I'm going to show a couple of the same metrics here. In blue, you have the free cash flow from the business. So kind of all over the place. But you can see that shares outstanding are almost down 70%. Now, debt has increased over this period of time, as you can see in the red columns, but so has net income. So the business is doing relatively well. There's going to be ebbs and flows in the rental car business, but if you can generate a solid return and not make big mistakes like Hertz made during the pandemic, this can be a really solid cash flow business. And the valuation is not too bad right now. As I'm recording, the price to earnings multiple on a forward basis is only 8.6. On a trailing basis, it's only 3.3. So that's the kind of price you want to have for a company that's buying back stock. Avis Budget Group may not be the kind of company that seems attractive from an investment perspective, because rental cars just aren't that sexy of a business. But when you consider that they're generating pretty good yields from the business and they're using most of that money to buy back stock, looks pretty attractive from an investment perspective today. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The next company is another business that's just solid and generates a lot of cash flow. That is Valvoline. This chart shows the company's revenues in blue, net income in orange, and the weighted average shares outstanding. And you can see that revenue continues to grow. The company is very solidly profitable. And look at this change in weighted average shares outstanding. A 5.5% annual drop or compound annual drop in shares outstanding. Again, another one of these businesses that I think is always underestimated by investors. Yes, moving to things like electric vehicles is going to make it a little bit harder to get people to do traditional oil changes. Yes, we're going longer. Yes, we're going longer between oil changes. But the business continues to be extremely consistent, and maintenance is something that everyone has to do for their vehicles. And I think Valvoline has shown the ability to just continue to adapt the business and continue to generate profits year after year. The valuation isn't quite as good as the two stocks I've talked about earlier. The valuation isn't quite what it is for the other three companies I'm going to cover today, but price earnings multiple is 27 on a trailing basis and a 24.6 on a forward basis. I think this is just the kind of consistent company that's going to continue to buy back shares little by little over time. Doesn't need to grow the business. They can just be a buyback company and generate solid returns for investors. The final company is one that I've been talking about here on Asymmetric Investing for quite a while. One of the biggest buyback companies in the world today, that is General Motors. They had just announced a $6 billion buyback program. That was after announcing a $10 billion buyback program in November of 2023. Shares outstanding down about 16% in the last 2 quarters. And management continues to double down on these buybacks. Again, a company that has a core business that just continues to spit off cash year after year. And what is management doing with that cash? Well, yes, they're investing in electric vehicles. Yes, they're building out a business like Cruise, but they still have excess cash and they're using that excess cash to buy back shares. This is something that buying back shares at a 4 to 5 times price to earnings multiple is going to be extremely advantageous for investors as long as General Motors stays profitable. And I think my contrarian view on the auto industry today is that GM is not going to be disrupted nearly as much as people think by electric vehicles. I think they're just going to become a cash flow machine with internal combustion engine trucks and SUVs, and you have the upside with a business like Cruise. So add all of those things together, and I love GM's position, and the buybacks are a huge reason why. Shares outstanding have dropped like a rock over the last few years, and that will continue as long as the stock stays where it is. So this is the great advantage for owning a company like General Motors, generating a ton of cash. If the stock stays low, management is going to continue buying back stock. If the stock goes up, they can say, hey, you know what? We're going to hold off on buybacks at a little bit higher price, but then you have the higher stock price as an investor. So both great options, I think, and General Motors is one of my favorite buyback stocks. So those are my 4 picks for buybacks. Buybacks are going to be much more impactful on a company's fundamental value and the value you generate as an investor than stock splits are. Yes, stock splits are much more fun to talk about. There's something that traders latch onto, but long-term, what's going to drive stock prices is going to be revenue growth, earnings growth, multiple expansion, and how many shares there are outstanding. So buybacks is going to reduce that number and should long-term push stock prices higher. But what do you think? What are your favorite buyback stocks? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you next time.